Hello and welcome. Today we are going to explore something incredibly valuable for anyone interested in trading. We will be talking about volume indicators. Are you curious about how volume can make your trading strategy stronger? By the end of our time together, you will have a solid understanding of what a volume indicator is, why it is important, and how you can use it to make better decisions. Before we dive in, imagine trying to decode the hidden language of the market. What if you could have a tool that reveals the intensity of buyer and seller interest, helping you determine the likelihood of future price moves? That is exactly what a volume indicator does. So let us start by figuring out what a volume indicator actually is. A volume indicator shows the number of shares or contracts that are traded over a specific time. Usually, it appears as bars below a price chart. Have you ever looked at a chart and wondered about those bars underneath the prices? Those bars give us a clear idea of how much interest traders have in a particular stock or asset. If there is a lot of volume, it means there are many traders involved. This is important because volume can help confirm how strong a price movement is. It tells you whether a trend is likely to continue or if it might change direction. Now, let us expand on the different types of chart patterns you might come across when using volume indicators. Chart patterns are visual shapes that help us understand what the price might do next. Some common chart patterns include head and shoulders, double tops, double bottoms, triangles, and flags. Each of these patterns, when combined with volume analysis, can give you a clearer signal of what might happen. For example, the head and shoulders pattern is one of the most famous reversal patterns. It looks like three peaks, with the middle peak being the highest. When you see a head and shoulders forming, pay close attention to the volume. During the formation of the right shoulder, if volume starts to decrease, it is a sign that the uptrend is weakening and a reversal might be coming. On the other hand, if the price breaks the neckline with a sudden increase in volume, that can confirm the reversal. Another common pattern is the double top or double bottom. A double top looks like two peaks at roughly the same price level, while a double bottom looks like two troughs. In both cases, volume plays an important role in confirming the pattern. For a double top, if the second peak forms on lower volume, it suggests that buying pressure is weakening and a reversal may be near. Similarly, for a double bottom, if the second trough forms with lower selling volume, it could signal that selling pressure is fading and the price might soon rise. Triangle patterns, such as ascending, descending, and symmetrical triangles, also benefit from volume analysis. In an ascending triangle, the price makes higher lows and meets a horizontal resistance level. If the price breaks above resistance with high volume, it is a strong signal that the breakout is valid. Conversely, in a descending triangle, if the price breaks below support on high volume, it signals that the sellers are in control. Flags and pennants are continuation patterns that show brief pauses before the price continues in the direction of the trend. When you see a flag or pennant forming, volume should decrease during the consolidation phase and then spike when the breakout occurs. This helps confirm that the trend is continuing and that the breakout is real. By understanding these chart patterns and using volume to confirm them, you can significantly improve your trading strategy. Volume is like a magnifying glass that lets you see the strength behind price movements, giving you more confidence in your decisions. Now that we understand what a volume indicator is, let us talk about how to use it. When there is a lot of volume during a price increase, it means a lot of people are buying. This means that the price might keep going up, But if the volume is low during a price increase or decrease, it could mean that the movement might not last very long. Have you ever seen a stock go up in price, but there were not many people buying? That is something to pay attention to. Let us also talk about what happens when we see a sudden spike in volume. A spike in volume often happens during big market moves, like breakouts or reversals. If you see a sudden jump in the volume, it can mean there is an opportunity to trade. Keep an eye out for these moments because they can signal that something important is happening. Now let us get practical and talk about how to add the volume indicator to your chart. It is actually pretty easy. Just open your trading platform, choose the stock or asset you want to look at, and select the volume indicator from the list of indicators. You will see bars appear at the bottom of the chart, and they will show how many trades happened during each time period. You can even customize it to make it easier to see. You can change the colors or make the bars thicker if that helps. How simple is that? While adding the volume indicator is a straightforward process, let us also discuss using chart patterns to get more out of your volume analysis. One common chart pattern to watch for is the cup and handle. The cup and handle pattern is a bullish continuation pattern where the price forms a rounded bottom followed by a smaller consolidation, which looks like a handle. For this pattern, volume plays an important role. During the formation of the cup, you often see volume decreasing, which shows a lack of selling pressure. When the handle forms, volume may stay low. A breakout above the resistance level of the handle with a sudden increase in volume is a strong bullish signal that the price might continue higher. Another important pattern to consider is the wedge pattern. There are two types, rising wedge and falling wedge. A rising wedge is a bearish pattern that signals a potential reversal, while a falling wedge is a bullish pattern. When a rising wedge forms, you may notice that the volume starts to decrease, suggesting that the buying interest is fading. If the price breaks below the wedge support line with increased volume, it is a sign that a downtrend might begin. On the other hand, for a falling wedge, volume will often decrease during the formation of the wedge, but when the breakout occurs with an increase in volume, it signals a possible uptrend. Another pattern you might encounter is the rectangle pattern, which represents a period of consolidation. In this pattern, the price bounces between a horizontal support and resistance level. During the consolidation phase, volume tends to be lower, but when the price breaks out of the rectangle, whether to the upside or downside, the volume should increase to confirm the move. If the breakout occurs with low volume, it could indicate a false breakout, and the price may return to the previous range. Rounding tops and bottoms are also worth mentioning. A rounding top is a bearish reversal pattern, while a rounding bottom is a bullish reversal pattern. During the formation of a rounding top, you may see volume gradually decreasing, suggesting that the upward momentum is fading. Once the price breaks below the support level with increasing volume, it is a strong indication that the trend is reversing. Similarly, for a rounding bottom, volume will often be low during the initial stages and then increase as the price starts to break higher, confirming the reversal. By recognizing these patterns and understanding the role of volume in confirming them, you can gain deeper insight into potential market moves. Chart patterns, when combined with volume analysis, provide a powerful way to assess market strength and predict future price actions. But now you might be asking, how do we read this indicator? Well, when the price goes up and the volume is high, it means that more buyers are getting involved. This supports the idea that the uptrend is strong. But what if the price goes up and the volume is low? It might mean that the movement is not very strong and could change soon. On the other hand, if the price is dropping and the volume is high, it means there is strong selling pressure and the downtrend might continue. But if the price falls and the volume is low, it could mean the sellers are not very committed and a reversal might happen soon. Are you starting to see how volume can play such an important role in your trading decisions? Next, let us talk about using the volume indicator to confirm trends. When you are looking at an uptrend and you see the prices going higher while the volume is also increasing, that is a good sign the uptrend is strong. On the flip side, if the price is falling and the volume is going up, it means there is strong pressure to keep selling. This relationship between price movement and volume can help validate trends and their strength. Let us also go into more detail about chart patterns that are particularly helpful when analyzing volume to confirm trends. One of the most significant patterns to recognize is the ascending triangle pattern. In an ascending triangle, the price makes higher lows and tests a horizontal resistance level multiple times. During this time, if the volume starts increasing, particularly when the price is getting closer to the resistance, it is a strong indication that a breakout may soon occur. When the price finally breaks above the resistance with high volume, this can confirm that the uptrend is likely to continue. Another pattern to consider is the descending triangle, which is similar but forms during downtrends. In this case, the price makes lower highs while finding support at a horizontal level. During the formation of a descending triangle, volume often decreases as the pattern progresses, reflecting reduced trading activity as traders wait for a breakout. When the price finally breaks below the support level, if volume also spikes, it indicates a strong continuation of the downtrend. This breakout with high volume confirms that the sellers are gaining control, and the downtrend is likely to continue. However, if the breakout occurs with low volume, it could indicate a false breakout, and the price might struggle to maintain the downward move. Watching how volume behaves during the formation and the breakout can provide a clear indication of the strength of the movement. The symmetrical triangle pattern is another valuable pattern to look out for. In a symmetrical triangle, the price narrows into a triangle shape with both lower highs and higher lows, forming a point where buyers and sellers are in a standoff. During the formation, volume often decreases, indicating reduced trading activity as traders wait for a breakout. The narrowing price action suggests that the market is consolidating and a decisive move is imminent. Once the breakout happens, if the volume surges, it helps confirm the direction of the breakout. If the breakout occurs on low volume, however, it could be a false breakout, and traders should exercise caution. It is also important to watch how the price behaves shortly after the breakout, as retests of the breakout level with increasing volume provide further confirmation that the move is genuine. Furthermore, double tops and double bottoms are classic patterns that can be combined with volume analysis. For double tops, when the second peak forms with lower volume than the first peak, it is a strong signal that the buying pressure is weakening, suggesting that a reversal may be near. In double bottoms, if the second trough forms with lower selling volume than the first, it implies that selling pressure is fading, making an upward reversal more likely. Finally, let us not forget about reversal patterns like head and shoulders or inverse head and shoulders. In a head and shoulders pattern, the volume should ideally decline as the second shoulder forms, indicating that buyers are losing strength. The break of the neckline with increased volume then confirms the reversal. Conversely, in an inverse head and shoulders, declining volume throughout the formation shows weakening selling pressure, while increased volume during the breakout signals a possible trend reversal to the upside. But you also have to watch out for something called divergence. Divergence occurs when the price is moving in one direction, but volume is moving in the opposite direction. For example, if the price is rising but the volume is falling, it could mean that the trend is getting weaker and a reversal might be coming soon. This is known as bearish divergence and can be an early warning sign that the uptrend lacks strength. Similarly, if the price is falling but the volume is decreasing, it might signal that the downtrend is losing steam and a reversal could be near. This is known as bullish divergence. Have you ever seen a price that kept climbing, but you were not quite sure why the volume seemed low? Recognizing divergence can help give you clues about what might happen next, even if the price seems strong at first glance. Let us now explore how volume can be used for breakout confirmation. What is a breakout, you might ask? A breakout is when the price moves beyond a key support or resistance level. But not all breakouts are the same. If a breakout happens and there is high volume, that means the move is likely strong and could keep going. But if there is low volume during a breakout, it could mean that the move might not last and could even reverse. For example, if a stock breaks above a resistance level and there is a big jump in volume, this is a good signal to trade in that direction. Have you ever taken a position on a breakout only to see the price reverse and leave you frustrated? Understanding volume can help you avoid that. Volume can also help you spot reversals. If the price is moving in one direction, but suddenly there is a sharp change in volume, it might mean a reversal is coming. Imagine that a stock has been steadily climbing, and then suddenly the volume spikes while the price drops. This suggests that sellers are stepping in and the trend might be reversing. Recognizing these signals could make a huge difference in your trading strategy. As we continue, let us discuss how volume can be combined with other indicators. You can use volume with moving averages to smooth out price trends. If the price crosses above the moving average and the volume is high, that is a strong signal that the trend might keep going. Have you thought about how adding a moving average could give more context to your volume analysis? Another great way to use volume is with something called the Relative Strength Index, often referred to as the RSI. The Relative Strength Index can show if an asset is overbought or oversold, giving you insight into potential trend reversals or continuations. For example, if the RSI indicates that the asset is overbought but the volume keeps rising, it could mean that there is still strong buying momentum and that the trend might continue for a while longer. On the other hand, if the RSI shows overbought conditions and the volume starts to drop, it could signal that the buying interest is fading and a reversal might be on the horizon. The combination of these two indicators can provide a clearer view of what might happen next. How confident are you with the indicators you are using now, and do you think combining them could give you more accuracy in your trading decisions? And we cannot forget about combining volume with support and resistance levels. Support and resistance are key areas where traders make decisions. When the price is getting close to an important support or resistance level, it is crucial to watch the volume closely. High volume near these levels can often lead to major price action, whether it is a breakout or a reversal. This is because high volume around support or resistance indicates that traders are heavily interested in that price point, often leading to significant moves. For example, if the price approaches a resistance level and volume spikes, It suggests that buyers are eager to push the price higher, increasing the chance of a breakout. The high volume shows that there is genuine interest from buyers to overcome the resistance, making the breakout more reliable. However, if the price reaches a resistance level but volume remains low, it could be a sign that buyers lack the conviction needed to push the price beyond that level, which may result in a failed breakout and subsequent reversal. Conversely, if the price reaches a support level and volume spikes, it can indicate that sellers are putting pressure on that level, which could lead to a breakdown. High volume at support means there is considerable selling interest, and if the price eventually breaks below support with strong volume, it confirms that sellers are in control and that a continuation of the downtrend is likely. However, if volume is low at the support level and the price bounces, it might indicate that the selling pressure is not strong enough, making a reversal more probable. By observing the volume at these key levels, you can better anticipate whether the price will break through or reverse direction. This combination of volume with support and resistance can really help strengthen your analysis and give you greater insight into potential trading opportunities. For example, traders can use this information to set better entry and exit points, ensuring that they are trading when there is significant interest, reducing the risk of false breakouts or breakdowns. Let us put all of this into practice with some examples. Picture a stock that is trending upward and the volume bars are getting larger. This shows that more traders are entering the market, which supports the upward momentum. On the other hand, imagine a stock breaks above a resistance level, but the volume is lower than expected. This could be a sign of a false breakout, and the price might soon reverse. How useful would it be if you could recognize these patterns before they happen? As with any tool, there are some common mistakes to avoid when using the volume indicator. One big mistake is ignoring price action. Do not rely on volume alone. Volume should always be analyzed alongside the price action to give you a complete picture. Another mistake is overreacting to volume spikes. Not every volume spike is significant. Focus on consistent volume trends and do not get too caught up with one-off spikes that do not match the price movement. Now, let us talk about adjusting the volume indicator for different market conditions. In a trending market, when volume rises during a price move, it confirms the strength of the trend. When volume falls, it suggests the trend is weakening. In range-bound markets, volume can signal potential breakouts. Watch for increasing volume as the price nears a support or resistance level to anticipate a move. Have you noticed how market conditions can affect your strategy and how volume might help you adapt? As we wrap up, remember that the volume indicator is a powerful tool for confirming trends, spotting breakouts, and understanding market sentiment. Start applying the volume indicator to your charts and combine it with other indicators to create a well-rounded strategy. The more you practice with the volume indicator, the better you will get at understanding market sentiment and finding opportunities. Keep practicing, stay curious, and do not hesitate to ask questions or discuss what you are learning with others. Thanks for being here and happy trading.